So this is a huge problem, because if the markets recognize that inflation is here to stay, that is a whole new ball game for gold and the dollar.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The positive signs, I think, in the precious metals market, the fact that financials are going down, you've got bonds falling, that's going to be bad for the banks, it's going to be bad for the overall stock market. We've had this hyped up short covering rally that has surprised a lot of people based on the magnitude of this rally, particularly when it comes to the NASDAQ and the tech stocks. But all the time, the markets have been ignoring the reality of horrible underlying economic fundamentals that should be weighing on the market. Now, of course, the markets got beat up pretty badly in 2022, and so we rallied from probably an oversold condition at the end of that year. But the fundamentals, as far as I'm concerned, got worse, not better. But there was a lot of false hope that the inflation genie was, going to be put back in the bottle based on the fact that, 9% year-over-year CPI gains went down to a 4 handle. But as I've been saying, that's the trough. We're going back up. The inflation curve is going to bend higher, and we're going to start to print numbers with 5 and 6 handles and higher at a time when the economy is going to be weakening, in fact, entering officially a recession, maybe matching what we've unofficially been operating in. Again, if we've got the most bankruptcies since the end of the Great Recession, generally you don't get that happening if times are good, right? Companies are going bankrupt when times are not good. And they're not, especially when you had interest rates at 0 or close to it for more than a decade, and now they're 5% and rising. That's going to create a lot of problems for a lot of companies. But let me get into some of the other economic data points. There were a lot that came out on the week, and again, all this stuff is a negative. So the Challenger job cuts numbers that came out on Thursday, and that was a big number, not as big as the prior number, which was 80,000 job cuts, but it was still 40,709 were the announced job cuts for the month. Look at construction spending. That was one of the few numbers that was better than estimates, but there was a big revision to the prior month, which was originally reported as up 1.2. That was revised to just up 0.4. And so the consensus for May was up 0.5. We were up 0.9. But if you think about the fact that we rose 0.9 from what was downwardly revised from up 1.2 to up 0.4, the total level is lower than what was expected. And in fact, the year-over-year numbers really moved south. The increase in spending year-over-year went from 7.2 to 2.4. Now, this number is not adjusted for inflation. Anybody who's involved in construction knows that costs are up more than 2.4% year over year. So that means in real terms, construction spending is falling, which means construction is falling. It's just that what is being constructed is more expensive, and that's why the numbers are going up. Factory orders for May, also a big disappointment. They were looking for a gain of 0.9. Instead, we got a gain of 0.3. Again, this is not because more stuff is being ordered. It's because less stuff is being ordered. It's just more expensive. That's why the numbers are going up. And the prior month was revised from up 0.4 to up 0.3. ISM for June, another bad number. They were looking for a bad number. They got an even worse number. The expectation was for an improvement of the weak number we had in May. The May number was 46.9. Remember, anything below 50 is recession, right? We're talking about the strong economy, and these ISM manufacturing numbers are in the recession zone month after month. they were looking for an improvement to 47.3. Instead, it went in the other direction to 46 even. That was lower than the low end of the estimates. The range went from 46.6 up to 48.5, and we came in at 46 even. So again, these are negative numbers even before we're officially in a recession. The ISM Service Index, though, that's the only one number, really that was a strong number on the week, right? So, I mean, that one came out at 53.9. So that one's back out of recession territory. It was at 50.3 the previous month. The estimate was 50.8. And so that one, is above 50. But, I think the manufacturing is the more important, even though you have more jobs in the service sector. The higher paying jobs, those are in manufacturing. And we've got to manufacture. That's key. We got to make stuff. And so if we have fewer people making stuff, even if we have more people employed in the services, they still need to buy stuff. And that means bigger trade deficits, and a weaker dollar. The weekly jobless claims numbers, they're staying elevated, 248,000, a few thousand more than the prior week. But remember, those claims were hanging out around 200,000 before they spiked up to around 260. So we are starting to see more cracks in the labor market, not just the weakness that we saw in the jobs numbers. I got a few more of these here. The JOLTS number back below 10,000. Remember last month it was 10 million. Excuse me, 10 million. Last month in April it was 10.3 million job openings, and that dropped now to 9.824 million. So a bit of a decline in the jobs. But again, I'm looking at the PMI. This is the June number. All right, this is back above 50, 53.2. I'm not actually sure what they were looking for there on that one. I'm just looking at the total number. I got a couple more. The PMI manufacturing. This was another weak number, 46.3 on that one. That was, I think, in line with consensus, but again, well below 50, a number that you would expect to see during a recession. We also got the trade numbers. Again, the total trade in goods and services. So that's the smaller deficit because it includes the surplus that we have in services. And so that deficit came out at 68 billion, a little bit better than the 69 billion that was estimated, and a little bit better than the 74 billion from the prior month. But again, this is a huge number. This trade deficit, almost $70 billion a month. We're looking at $1 trillion a year. It still amazes me that every month nobody reports on the trade deficit. It's like a yawn. Nobody even cares how bad this number is. I wonder if there's even a number that can be so bad that it would be reported on. But nobody even bothers to notice. In fact, if anything, the way the media would react to a really, really bad trade deficit, like a number that blew everything away, the media would probably say, wow, the U.S. economy is so strong that we had this huge trade deficit. Because that's how they talk about it. If they even bother to discuss the trade deficit, the major economists, the newspapers, or the internet articles, when they write about it, they always talk about the trade deficit as evidencing the strong U.S. economy. Like our economy is stronger than our trading partners. And because our economy is so strong, we're just buying so much stuff, right? Our strong economy is generating all this spending. And because our economy is stronger than, let's say, the Japanese economy or the European economy or the Chinese economy, we're running a trade deficit. Our economy is so strong, we're spending so much more than everybody else. Of course, that is pure nonsense. We don't have a trade deficit because we have a strong economy. We have a trade deficit because we have a weak economy. You know, once upon a time, America had the strongest economy in the world, and we had the biggest trade surpluses in the world at the same time. You see, when your economy is strong, you produce a lot of stuff. You produce more stuff than you need, and you export the surplus. So strong economies are productive economies. They produce excess stuff, more than they need. See, we're trying to redefine strength as spending. Spending money is not a sign of strength. In fact, it could be a sign of weakness if you're borrowing that money, which is exactly what we're doing. You know, other countries are saving while we're going into debt. Those are the strong economies, not America. It's the countries that are operating with trade surpluses, that produce more than they consume. Those are the strong economies. It's a weak economy that consumes more than it produces. It's an economy that is made up of people who are living beyond their means. Is that what you do when you're strong? Do you live beyond your means? No. When you're strong, you have so much means that you can live beneath them, that you can accumulate savings. That's how you accumulate wealth. So even when they report on the trade deficit, they misreport. They don't understand it. And again, I think it's because so many people are of the mindset that America has a strong economy, that they take this weak economic data and they somehow try to sugarcoat it, or their mind just can't comprehend that it's evidence of weakness. So people take this weak economic data and they spin it as if it was strong. And a lot of people just, oh yeah, sure, we have a strong economy, so we go out and spend. Right? These other countries, they don't have all that economic strength, so they can't spend so much. And maybe superficially, if you don't really have much of an understanding of economics, you know, you could buy this. And unfortunately, most of the people who are economists in this country, who teach economics or who are professionals that work for the government or the Federal Reserve, they don't understand anything about economics either. So they might think that these trade deficits are a reflection of how strong our economy is, but the reality is it's the reverse. But what's more significant right now about the trade deficits is that it has to be financed. And we have $2 trillion budget deficits. Nobody talks about the twin deficits anymore. They were a huge problem in the 1980s. Everybody talked about the twin deficits back then because we were running trade surplus, trade deficits, and budget deficits. And they were a problem. They were a big problem for the bond market. They were a big problem for the dollar. And they became a big problem for the stock market. In fact, the trade deficits and the impact it had on the dollar and the bond market is probably the real reason that we had the stock market crash in 1987. But today, nobody cares about either of these deficits, even though they're both much bigger now than they were back then. Well, nobody cares until they care. And I think soon people are going to start paying attention to these numbers. And again, what I think we saw in the markets this week, and especially on Friday, given the failure of the bond market to rally on a weak jobs number, okay, given the fact that the dollar and the bond market decoupled, where the dollar sold off and bonds sold off, or coupled, because they had been trading opposite, right? Because they were all trading rate. The currency traders were looking at strong economic data, which was bad for bonds. They were buying the dollar. So even though they were selling treasuries, they were buying dollars. Now they're selling treasuries and dollars at the same time. That is a very bad sign for the U.S. economy and for the financial markets. And again, gold went up and oil went up. And oil went up a couple of bucks, but on a chart, we've now taken out some resistance. There was, oil was trading below 70 for a while, and now it's kind of broken out. And so it looks like there's a lot of room to go up. And if oil prices are going to rise, a lot of other commodity prices are going to rise too. And the main reason that we got the break in the headline CPI was energy prices and other commodity prices that came down. If they're now going up, if oil has bottomed and we're going up from here, that's going to start to put the upward pressure on these official inflation numbers. And remember, the whole time headline inflation was coming down, the core wasn't. I mean, the core numbers still stayed in the high 4s, low 5s. Never got anywhere near 2%. Because again, remember, the Fed is more focused on the core, not the headline numbers. And so we got more relief in the headline numbers than the core. But now the headline numbers are going to turn higher. And the core never really went down. And now that's going to turn higher. So this is a huge problem, because if the markets recognize that inflation is here to stay, that is a whole new ball game for gold and the dollar.